Hi, Warriors. How's everyone doing? I know we have Richard here and Jays and Sinatra and Ryan.
Hey, mate.
And Jerry and everyone's got a full house here. So good morning, Ryan. Kman, how are you?
Good morning, Dale. Good early morning to you.
Morning, mate.
Okay, so yen almost has made new highs here. It looks like a layup for new highs here.
And
Yeah,
it's been a case of a lot of euro crosses being bought over the course of the morning, which is likely having to do with the end of month, quarter, half year.
The wonky stuff.
Yeah, wonky stuff indeed.
Yeah. Okay.
So yeah, it's been again a case of versus various currencies, dollar having been beat apart from the euro. So it's more like euro crosses, Swiss crosses, euro Swiss tagged the parity there, and yen was one of the currencies that has been sold. Yeah.
Yeah. So this is going to be the second divergence at new highs. So we'll see what happens. I know that after yesterday's down day in the S&Ps, that the bears' confidence is growing, that this is just another, just quick little failing rally. It could be a failing rally, but I think there's another piece of it left. And I kind of like this 50% zone, which it almost got down to, or 61.8 for a repeat of this. So I think that's going to happen because I think we're close to what could be an important high in the yen. And yields really didn't perform that well yesterday. I mean, they're like two different charts, right? The yen's about to make a new high, and yields are putting in lower highs. So, if the correlation is going to come back together, and maybe
something has to give.
Yeah, what do you think? I think yields are right. I think that a lot of people say the smartest markets are the bond market. The bond market usually gets it right. So, what do you think? Probably
in a certain way, some of the FX flows that we see are derived from bond moves. So
yeah,
they should be the smartest kid in the classroom. I mean, I've taken profits yesterday on my long dollar yens. I'm just watching the game, having a beer, and see what happens into end of month, quarter, half year, and on Friday perhaps, because I've seen a bit everything and the opposite, calling for okay, this was the rally in stocks, and now we're going back down, and other people saying, like, hang on a minute, this is just wishy-washy rebalancing, and then on Friday we start the party again.
Yep. So you have to scalp in these markets, don't you? But I do think there are some inflection points developing here. So I look at the dollar. Are we going to make one more new high? Under here, I don't think so. But as long as we're above it, kind of looks like the dollar has had 1-2 drives, and maybe one more. Flush it out. One more high, and look at this chart. And this is the weekly dollar index, and then look at the daily on the yen, and there are some similarities.
Oh yeah, definitely.
Between, although the yen on the weekly is still so strong, it's a much stronger weekly chart in the yen than it is in the dollar. Even if the dollar makes a new high, it's lagging.
Yeah, I was saying this morning on the Flow show, I think it's going to be more about timing than levels. If we find a top in in the dollar, or let's call the top in the dollar yen, for instance, is going to be more about timing than really the levels. We could do this stupid or push, just a normal push into the end of month, and then see where we end up, and perhaps that's going to be your third level, and
Yeah.
where we can start to counter trade it. Yeah, I mean,
what news out there in front of us, both of you guys, do you think could be like an event to where a market could climax on? The inflation numbers coming up this week or something next week? What do you guys think is going to be? Go ahead.
My personal view, it's not going to be inflation data anymore. It's going to be growth data.
Growth. Okay. So GDP number?
Oh, GDP and the whatever PMIs, but real data. When the consumer is going to tell us that he's had enough of high prices, things like that. Like the
right weakness. Sign of economic weakness is what's going to turn things.
I think so, and then we could see a real top or bottom in the yen as a whole versus quite a few currencies.
Okay, Stel, any news if you're around? Are you? Okay.
I am here. Good morning.
Okay, any news you think could be an inflection point for a dollar peak and or a US dollar yen peak?
I personally think inflation is still the thing to watch because that's what the Fed is trying to fight. That's what the whole world is trying to fight. I do agree with Kman that the consumers' behavior is going to be important to see how it shifts, and it's already shifting. But as long as central banks are targeting inflation, which they are primarily, I think that's what everybody's looking for. Where's the peak? And when that peak seems to be here, that's when I think things will turn, and and we have the next big leg the other way. So, but I don't think we're there yet. And I've said this so many times. I think we still have higher to go in yields, higher to go in rates, and central banks are hiking, and they're going to continue to do so until stocks have a proper flush, capitulation flush lower. So unfortunately, I don't think anything's changed yet. I still think we should be selling rallies in risk. I thought the S&P would climb towards 4,100. It seems to have done very poorly yesterday. Nasdaq was leading that. Actually, tech stocks absolutely had a shocker yesterday. But I still think this bear market rally, short squeeze, call it whatever you want, may have a little bit more legs higher. But I do think that the macro view still remains sell risk on rallies and buy dips in yields until we know otherwise.
One interesting aspect of this recent rally in the markets has been the relative strength, and surprisingly, it's been the Russell. So the Russell had this huge breakdown. We held it here, and then we broke down under this, important area, and we're back above it. But you look at the rally in Russell, and look how much further away it is from the lows compared to NASDAQ, but it's been outperforming. I asked some guys, and why, and it's really considered more the spec area. You don't find blue chips in the Russell 2000. So money's starting to go after rotating into this stuff, which has been the most depressed for quite some time. So it actually left an island bottom, and they're kind of rare. So as long as Russell stays above here, I think there's more upside. I don't think one down day after this rally changes the S&Ps. I still think we'll get to where you were talking about up here.
Have a look at the shorter time. Have a look at the hourly or the 15-minute, Dale, on that, and look where we found support.
Yeah, at previous it was like that breakout area,
Right on
38.
that 38.
Yeah.
11 area.
Yeah, the 38.10 was, right here.
Yeah.
Holding it, and then we had the blow off day on Friday. So it's pulling right back to support. Why can't we have another one of these from in here and take you up there?
Yeah.
So you'll get your 4,100 shorts still. Nostra Pinkert thinks so. So anyway, Blake, you want to chime in here, buddy, and tell us what's on your mind?
Yeah, good morning, guys.
Good morning.
And everybody, gals, and everybody else. We're seeing this, bounce and wrist this morning, and I have to say the 38.10 level. I mean, I can't tell you how many times we've mentioned that level, and we were talking about it in our chat room just a little while ago, or when I got up this morning, about what a critical level. And let me just go ahead and grab the screen here.
Go ahead.
If you have been listening to our daily trading shows for the ForexAnalytix community, I mean, we've talked about 38.10 about 1,000 times, because you can see it from this previous low back in May. It's just been a very pivotal level for the last few weeks. Yeah. And
traders learn to look left, right, Blake?
Yeah, that's, and the veterans do, and the veterans know, Dale, people like yourself that have been around for 400 decades really understand that,
I got it in the 400th.
You're in the 400, your 400th, you finally figured it out.
Yeah,
but
I said, yeah. Well, I'm left-handed anyway, so it's easy.
The one thing I want to point out about, and I'm gonna take this right now for a moment, and I'm gonna give you guys a little bit of lesson in technical analysis for those of you that don't know this. So when you're looking at fib levels, so let me just grab something really quick. I'm gonna grab the drawing tool. So when you're looking at Fibonacci's, right? So this is like the top of the move. This is the bottom of the move. And from on the right-hand side, you can see the different fib levels, the 24% retracement, 38%, so on and so forth. My favorite being the 618, the biggest pivot out there. When you start testing like the 78%, the 618, but basically that tells you you're in a range, you're not, and the market's in a range longer or more often than not. Right. I mean, it just is by default. I would say, I don't know, 75, 80% of the time we're in a range. But when you are looking at a trending market and you're thinking, okay, well, the market's going to trend one direction or the other. When you pivot off of a 38% retracement or, even a 50% retracement, the risk is that you have a continuation. So what I'm trying to tell you is, if this is the low, this is the high, this is a 38% retracement, the risk is that we'll have a continuation pattern higher. Does that mean that the S&P is going back to 4,500? No. What that could mean, though, is it will be an equal leg of this level to this level, so it might take us back to 4,100. If today's lows hold, that's what I would be thinking of. So that's a little education for those of you that are not familiar with how to use Fibonacci levels. It's something that we talk about all the time. In our trading community, we discuss things like this all the time. But I saw Jay said that 3950 levels is 618. It is, but today's low was 3809. This is the level that matters, right? So that's all that matters. So I wanted to address something that who wrote it earlier? I have to go back. Oh, Lloyd says, what do you think of the 3-arrow default? And that's, if you guys aren't following us, 3-arrow is they're a Singapore-based fund out of Singapore-based fund out of Singapore, Singapore crypto fund, and they're apparently defaulting. And I don't think much about it. I mean, is it big enough where it's affecting the rest of the crypto market? Maybe, but this is how many funds are going to go defunct, and how many altcoins are going to go to zero. I mean, you think about like the .com bubble days. we've been talking about this for years. Every altcoin, just I'm just going to pull up any altcoin. Let's go to crypto really quick and let's just backspace all of this. And we're on TradingView. You can just start pulling up any coin that's not Bitcoin or Ethereum, and you're going to see a 90% drop, maybe 85% drop from the highs. That is, again, it doesn't really matter which one you pull up. I'm just going to pull up anything. Those are all 85, 90%. I'm just pulling up anything. I've never even heard of any of these. But if you go back to the 1990s, think about what happened to boo.com, startup.com, pets.com. You're going to see a continued liquidation of every crypto asset out there until we probably get to a certain level that is of people find a value, which, if I go to Bitcoin, this is the chart that I did post yesterday, and I want to go ahead and be pretty clear here. This is a monthly chart of Bitcoin. If you take this low from 2017, low to 2019, 2020, that comes in around 7,000. If you look at the flag pattern that's developing here, this is the move from 32,000 to 17.5. That pennant actually points to about 7,000. You look at Ethereum. If Ethereum plays out to negative $2. I'm just kidding. I'm joking about that. I don't know where it goes to. It goes to about $200. So is there potentially some more, shakeups in the crypto world? The answer to that question is probably yeah, and it's going to go a lot further than most people anticipate. Most people are looking at Bitcoin and going, "Oh, it should stop, around 20,000. Maybe it might go to 12,000. Why can't it go to 7? Why can't Ethereum go from 2,000 to 200 or 1,200 to 200 from here?" So, in crypto, by the way, I don't think it's as widespread as you believe it is. I really don't think it's as saturated in the general economy. It was, as many believe, although I think there's going to be more pain for those people that are in it. So anyway, I just want to point that out because I think there was a question on crypto a little bit earlier. But hey, what I got to ask you, European guys, what do you think about that Spanish CPI data that came out earlier? Was that what created the low in the euro today?
No, it was the German stuff.
Oh, what happened? Did German? I thought German inflation data comes out a little bit later. I may be mistaken.
The German regional numbers come out before the headline number, and the first one dropped about 5:30 this morning, and it dropped 6 pips from 8.1% to 7.6% or something like that, and that shook everyone up. There were a couple of lower prints. It came in much lower. So that tipped the euro, tipped bonds down, or bounds, as whatever you call them in your language over there. So there's a bit of fun and games in there. And then the Spanish CPI came in much hotter. That jumped higher. Saw bonds yields rallying again and sent the euro back up again. So as we've been saying, you watch the data and the market's moving on the data now.
Yeah, it has. Yeah, I mean, data does matter, and everybody's one of the things that people have been, and I've heard this a lot in recent months. Macro is back in fuego, right? I think macro is almost a thing of the past now, and I don't want to say that to macro guys. We got Peter Boockvar, he's coming on, and I still appreciate what they're all saying, but really now data matters more than anything, right? It is data. Everything's going to be data dependent because data is going to influence what central banks are going to do.
Isn't data macro?
Yeah,
macro data, macro Marvin data, macro. Yeah, that's going to matter. So, I mean, the data is going to be very important. And speaking of which, we do have final GDP numbers today. I don't think those are going to be as influential as like the PCE numbers tomorrow, right? I mean, that tomorrow is going to be where it all matters.
We know it's going to be a negative number. We just don't know where exactly. We don't care now. We're looking at the next quarter now.
Yeah.
But inflation.
Q2, we're still getting Q1 data.
Yeah. Okay. So, PCE data is going to matter more tomorrow. We got final GDP numbers today that shouldn't really move the market. Oops, sorry. I had something. Sorry, I had something in my mouth. It shouldn't matter too much today because it is the final numbers. But you look at the yen, and I know you guys talked a little bit about the yen. You know what? A massive divergence that we're seeing right now is the yen, which I know you guys discussed a little bit earlier. But have you guys seen the Swiss franc? And just so you all know, this is a massive double top that points to like 90 cents. Just so it goes all the way down here. It's something I'm going to talk about. I'm giving you guys a heads up. I'm going to talk about it on the trade-off show that I do with Chris Weston every Wednesday, from Pepperstone. I'll be discussing this tonight. But this Swiss franc is dangerous looking. So what do you make of this divergence between these two currencies that have been so, and I know the answer, I think, but they've been so closely associated with yields up until a week and a half ago. What do you guys think? Maybe 2 weeks ago. I guess it was 2 weeks ago.
You're talking about different divergence between the yen and the Swiss?
Yeah. What is the big difference between the two?
S&P has gone hawkish.
Right. Yeah. Like the Swiss National Bank did
bathing in his sake bath. So
yeah, they did an about face. So I guess I've got to ask this: will the Bank of Japan ever do a Swiss National Bank about face? What do you guys think?
I think they will change something over the course of this fiscal year, but the window is rapidly closing, right? But I think they will do something. They can't be the only central bank in the world who hides behind temporary factors or their aging population forever. They are squeezing their own economy as well by keeping those low interest rates. And for the Swiss, we had it even before the S&B meeting where Jordan was saying that they were ready to do something, which was the plunge in Euro Swiss from 104.5 down to 102.5 that day. And I think it's just they are completely diverging now. They even said, Jordan even said that they think that Swiss franc is less overvalued. There is just a green light to buy Swiss from a couple of weeks before the meeting into the S&B meeting. So that's a huge diversion between Swiss and yen right now.
Yeah, huge. And can it continue here? I look at the Euro Swiss and, we're obviously this
parity.
Parity is big. And you can see multiple Gartley patterns. You know what a Gartley pattern turns into after a Gartley? Floats like a butterfly.
Crab.
So it could look something like this if things get a little out of control. So it's something that we should. I mean, if we start breaking parity here, trading down into the high 90s is entirely possible with this Euro Swiss. Crazy moves here in the Swiss franc. And I think a lot of people look at the Swiss franc and say, there's no way that's going to happen. But I mean, how many people have been parked short Swiss francs for when did the Swiss National Bank go negative? Stelios would know this. When did they dip into negative rates? Do you remember?
No.
Come on. Ryan would know. Ryan's got this on. He come on. Who's fastest at Wikipedia right now?
Was it 2012? They went negative?
Something like that, right? So I mean, how long have people been, shying away from Swiss francs and put, I mean, think about like a decade, maybe. I don't know. It's been a long time, right?
You like your generational move.
2015, by the way.
2015. I knew somebody was going to be fast on Wikipedia, and that was you, Stelio. So I'm sorry. What were you saying, Ryan?
I was saying you like your generational moves. Look at the Swiss yen chart on a weekly.
Oh yeah, I mean that's gnarly. And Woo, look at that. I'll pull it up on a monthly. Oh my goodness. Yeah, that's a gnarly looking move. And, you know, and speaking of, whoops, let me go over to the weekly chart. Speaking of yen moves, I mean, you got the Swiss yen that's obviously breaking out like in a, I mean, that's like looks like a wrecking ball, right? But look at all the other yen pairs too. I mean, you got the euro yen that's, you know, I'm just going to go to the daily chart. You know, we're moving right into resistance here. Sterling yen, you know, nice consolidation at the highs. Aussie yen, you know, triangle. Kiwi yen triangle. Canadian yen's actually breaking out of the triangle, moving higher. And, you know, Canadian yen bull flag pattern points, you know, even higher than where we're at right now. So, you know, if you're sitting here looking at the dollar yen thinking, well, I don't know if it's going to go much higher than this, I have to take cues from other yen pairs that look, you know, they look dangerously bullish, even after we've seen a swing lower in currencies too. I mean currencies. I'm sorry, in risk. You know, you've seen, you know, S&P is obviously trading heavy and all other markets. So anyway, really wild moves in the yen, the Swiss franc. What else do you guys have? What else are you guys thinking here? Anything else that is on your mind before we go into the GDP numbers? Don't all jump out at once, guys.
End of month, I'm traveling very, very light right now. Only have like a leftover euro Swiss short, just covered the rest of my euro MEX short, and I'm traveling extremely light.
Yeah. You know, I haven't really stepped up any of my dollar positions, although that I leaned into the dollar MEX a little bit yesterday as we were hitting the channel resistance around the 2015 level. I started adding to my position that I was short from, you know, a couple of weeks ago. I'm getting a little bit more aggressive in the MEX. And speaking of the MEX, you know, these emerging market currencies, well, at least the peso is looking a lot better. And in this environment, when the Mexican peso does well, heaven forbid if stocks actually rally, these you know, you might get the Mexican peso really coming unglued, where, you know, we're approaching some pretty key levels of support here in the dollar MEX. I mean, you know, 15 euro MEX continues to bleed lower. And I mean, the euro MEX, I mean, shoot, you know, we start breaking down below 2050, and I think that could get downright nasty as far as the euro MEX goes. So you'll see a lot of carry interest come in here, should equities actually finally, you know, be supported. But speaking of equities, we'll take a look at the S&P as we go into the final GDP numbers. Let me go ahead and fix this chart really quick. I think this is going to be really important today that the S&P holds the 3,800 level. And what else do we have?
Apparently, Powell is speaking as well. Anybody know where he's speaking? I saw this on the calendar.
Yeah, I was going to say we have the what's that?
The ECB forum. We've been talking about that. It's in our chat room as well. It's the ECB forum. They're having their yearly powwow with Lagarde, Powell, Bailey.
That happens in like, it starts in 30 minutes, right?
Something like it, yeah.
I think They've been waffling all day.
So what's that?
They've been waffling all day. It's one of those things where they just keep talking and talking and talking and talking.
I can't wait. There's nothing more I love than sitting and listening to central bankers all day. It's like, holy cow. It's like porn for geeks. Just kidding, guys. It's like the worst thing.
This pay off next year, by the way.
I was like, please, somebody kill me now. All right. So here's the, by the way, this is the data flash. This comes with ForexAnalytix. It's, you know, I paid $2,800 a month for Bloomberg. And really the thing I use probably the most is trying to figure out when the economic data was coming out as fast as it was. You guys get this data flash included with ForexAnalytix. So make sure you use it, you know, with your live squawk feed. It's that's included here. But I'm going to pull up the charts, pull over data flash, and we'll see that final GDP number come out. I got the dollar index over here, and you know, equities down below. Let me move this down just a little bit so we can see a little bit more of the charts. And that data should be out
5 seconds.
5 seconds. All right. Let's see if there's any reaction here.
Negative.
If it's not negative, it's going to be a big surprise.
There it is.
Minus 1.6.
Yep.
A little worse.
A little.
So
Yeah, it
what
doesn't
is
make doesn't make any difference, I don't think.
Yeah.
Hey, John, just so you know, Twitter, when you tweet stuff that you copy paste from Bloomberg, you still have to copy paste from Bloomberg. So you're going to get it behind everybody else, just so you know. All right. All right. So, all right. That is the data, and it's not really moving the markets a whole lot. And I think that's it. I think that's it for today. I want to thank everybody for joining. Hey, by the way, we had
You know what's funny about that, Blake?
What's that?
You know, he still thinks he paid because he said I paid 0. So even when it's 0, he still paid something.
Some people you can't change.
Anyway.
Hey, just to let you know, we had actually 2 traders qualify for live accounts with the Trader Funding Program. So if you want to learn how to trade our money and not your own and keep 75% of the profits, just watch the video at the very bottom here. I'll give you a little bit more information about the Trader Funding Program. Team, I want to thank you very much for being here. Happy Wednesday to you. Happy Hump Day. And Dale, it's all yours. I have a great interview with Peter Boockvar. He's always awesome.
Yeah.
Cheers, guys.
You know.
Thank you, Blake. And thank
I'd
you, Laura,
rather.
for the great comment.
And team, thank you very much. Laying it on the floor every day.
Thank you, Dale.
And okay, guys, have a good rest of the day. You'll catch you guys at 15 after for the morning edge. And Peter Boockvar, welcome back to F.A.C.E.
Morning.
How are
Thanks
you?
for having me.
Good to hear you, Peter. So I'm going to share my chart so we could go over things. So why don't we start with what happened today with the GDP reading?
It's old news. I mean, we're a day away from ending Q2, so Q1 is water under the bridge.
Okay. All right. So you did a great spot last week on CNBC, Peter. I caught it. And you were talking about they gave you a chance to be the Fed chairman and talk about what you would do. And, you know, it wasn't any surprise to you what they did, right? So looking forward, do you think the little break in commodity markets are enough for them to maybe taper their hawkishness, temper it?
Not yet. I think they're intent on getting the Fed funds rate to 3. Now, whether they get there, we'll have to see. But I think they're of the mind that they're more focused on getting the Fed funds rate to a certain level, called 3, from there, which they can pivot either way. So if they get to 3 and all of a sudden inflation starts to really roll over, well, then they feel they have rates to cut if they need. And then, of course, if things stay hot, well, then they have flexibility on the upside by having the Fed funds rate already at 3. So while they may say they're data dependent, I think right now they're almost, Fed fund target dependent, and that they just want to quickly get to a certain rate. Now, they're still only halfway there. They'll compensate by likely going 75 in July, which will take them to 2.5, which ironically is where the Fed funds rate was taken in the fourth quarter of 2018, 2.25, 2.5.
Okay.
So the question then is, after you get to 2.25, 2.5 at the next meeting, what do they do in September? They'll just probably raise another 50, but there's still a lot of things to digest between now and September. But if I were to say they would be 75 in July, it'd be 50 in September, and then they would have a chance in their eyes to sort of look around, survey the landscape, see how the economy and the markets have responded to their rate increases. At the same time, it's only going to be September when QT starts to max out. So that's very early innings in that form of tightening. So there's still a long way to go here.
So is this pullback in
and what the response is?
Yeah, this little pullback we had, and it was kind of a buy the rumor, sell the fact on the last Fed rate hike. is this just another pullback similar to this before we see a wave above 3.5% on the 10-year? Or is it already baked into the 10-year, what they're going to do next in July?
I think we can't. Well, I think the short end of the curve, I think the 2-year, 310 here is priced in all the rate hikes. So that, to me, I'm pretty confident that those yields have peaked. The longer end yields, 10-year, as you point out, is more difficult to predict because it's not just about U.S. growth and inflation that's driving the 10-year. It's what's going to happen with yield curve control in Japan, what's going to happen to European bonds as they finally stop QE tomorrow and eventually start raising interest rates in July, and where they can take them. So we've had an epic sovereign bond bubble over the past 10 years, and that was exaggerated by negative interest rate policy that is now reversing. And if we wake up tomorrow and go back to the Bank of Japan, if they decide to widen their yield curve control band to call it 50 basis points or even 75, I don't think they'll go to 75 in one move. It'll probably be in baby steps. Then we can wake up and we can have another round of global bond selling. If the German 10-year goes to 2.5% because the ECB's pussyfooting with tightening policy, then we can get to 4% in the 10-year. But we're not getting to 4% in the 10-year again because U.S. growth all of a sudden accelerates. It's because inflation's sticky and we have this continued unwind of this global bond bubble.
Who's on the other side of the runoff and the Fed not being a buyer? Who's stepping in for the Fed? And, I look at the TLT, Peter, and I don't think I'd be short bonds down here. Could we, have some type of bear market rally in bonds that would surprise people? And what would be a catalyst for a bond market rally? Because I don't know if it's going to be risk off.
You need the price of oil. I think you need in order to get a real bounce.
Okay.
You need oil prices below $100.
Okay.
I think. We had a bunch of auctions, treasury auctions this week, 2s, 5s, 7s, and they were all pretty crappy. So here you have the highest yields that we've seen in many years, and the auctions were crappy, which tells me that
no demand.
Bonds don't trade well. And one very, very important bond that I like to look at in this whole sort of global debate on yields is the Japanese 40-year yield. And I say 40-year because it is the furthest out on their yield curve and therefore the least influenced by their manipulation of negative rates on the short end and yield curve control at the 10-year. And overnight, it fell 3.5 basis points. But prior to that, at about 141, it rose to a 6.5-year high. And that tells me that the pressure is just intensifying on the BOJ and also in global bonds generally.
Okay, well, maybe we're going to have some type of important inflection point in the yen with what you're seeing out there. Parabolic move. Is this a crisis with what's happening with the yen and what the Swiss did by SMB turning hawkish?
Well, it's a budding crisis, and whether it actually rolls into one, we'll have to see. I mean, I think the yen needs to get to probably 150 before the screws are tightened enough that the BOJ would widen their band and therefore lead to a rally in the yen.
Okay. All right. I'm actually looking for something short-term top. How about the dollar, Peter? I mean, dollar was getting a lot of press. It's not getting as much because of the yen performance compared to the dollar. Does this look, technically, I'm starting to build a case for something toppy up here. Can you think of what's going on in the central bank world and the yield world, how there could be a bear case for the dollar, even if it makes one more high above 106 or so?
To me, the potential inflection point with the dollar was the as you mentioned, the Swiss National Bank surprising and raising 50 basis points, because that was, at least from their perspective, a sign that they're now obviously pivoting in a big way, and that other central banks are doing the same. And when you think about this rally in the dollar, well, up until a few months ago, it was really only against the yen, the euro, and the pound.
Right.
Commodity currencies were trading well. And then, of course, the dollar started to rally with everything else as commodity prices fell. But it's really just been about interest rate differentials and differentials in between different central banks. And if other central banks are going to catch up, well, then the dollar sort of loses its edge. And I would not be surprised again if that SMB move was the catalyst for a peak of the dollar. Now we'll have to see, but I think that's what I'm watching out for.
Okay, and should there be a dollar peak, do you have a preferred fiat alternative to the dollar, or is it still? And I understand the case.
I still like the commodity currency. I still like the commodity currencies because I think commodities, notwithstanding this pullback, are still in a bull market. So the CAD, the Aussie, in particular.
Okay. All right, and here's a look, Peter, at the Aussie, and it's a big consolidation triangle, and I'll be doing.
And I'm still intrigued by the pound too. I mean, the Bank of England's also beginning to shrink their balance sheet. I think they're going to pick up the pace of their rate increases. So I wouldn't be surprised if down the 120, 122 level, the pound bottomed as well.
Okay. All right. Definitely. I mean, just from a technical point of view, this looks like, it really hasn't given back much from the COVID low compared to things like the pound. You're right. The commodity currencies have had the relative strength, euro taking out the COVID lows.
Right.
So a lot of people have complained, Peter, about gold being a lousy inflation hedge. I've thought that it was going to take a bear market in the dollar that's more of a monetary hedge. But you have to respect, even though it hasn't gone up, how well it's held. I mean, they keep trying to break it, and it's holding pretty well. It was easier to understand being long gold while the Fed was in easing mode for all those years. What is the bull case for gold as there's more opportunity cost as rates go higher?
Well, your initial point of gold trading well, I mean, when you think about everything that's thrown at gold, yes, we have inflation, but the sharp rise in interest rates in response and the sharp rally in the dollar, and gold still trading between $1,800 and $1,900, which is pretty good performance. And gold has not been what people would perceive as a good inflation hedge, but I think that has more to do with the interest rate response to that rise in inflation. The catalyst for gold on the next move will be the Fed's knees that buckle in response to a recession, and that happens well before inflation gets below 2% or even at 2%, and that inflation's only down to 3 to 4, and all of a sudden the Fed starts worrying about a recession, and therefore therefore they want to pause, at least, because they're not just going to go from raising to cutting. They're going to go from raising to pausing to then cutting.
Right.
But the second that they pause, before they have predicted, right now the dot plot has them at near 4% next year. The Fed funds futures is saying something more like 3.5%. And if all of a sudden they stop at 3%, well, there goes your dollar rally, and you're likely to see a nice rally in gold and silver when that happens. But again, prior to that, gold's trading pretty well. Silver has been disappointing, no doubt, but gold is hung in.
Okay. Yeah, we need a top in this gold silver ratio for silver to begin to lead, and it looks like it's trying here. I like them both. In fact, Peter, I don't know if you really follow the miners, but
I do.
Just a couple.
We own them.
You do? Okay, you own them. All right. Well, I look at some of the gold miners. Here's GDX, and here's Newmont. Almost at new lows. And you talk about the weakness in silver. When I look at some silver shares, they're putting in higher lows. That's Endeavor, and that's Fortuna. So, you know, I'm seeing the opposite in the miners, that there's more relative strength in the silver shares. And what, you know, what I really wanted to get to, I'm going to bet $1, Peter, that no one's asking you, why would you like gold more than Bitcoin? You get that question anymore?
No, I don't get that anymore. I don't hear Bitcoin is digital gold anymore.
Yeah.
I don't hear that anymore. That's not to say that it maybe one day will be a complement to gold.
Yeah.
But when people were preaching to me that something that is 10 to 12 to 13 years old, depending on when they had argued this to me, that somehow that was going to replace something that's been around for 5,000 years.
Yeah. So do you think there's a possibility? I've heard some people and read some things that there could be a move out of crypto into gold after this decline, that people lose faith in it and it's not doing the things it was supposed to do for them during, you know, didn't do much for them when the dollar was strong. Let's see what happens, what it does for them if the dollar weakens. But
I mean, I just don't know how to quantify the amount of dollars that were in Bitcoin, which that holder would have previously been in gold. To me, instead of digital gold, Bitcoin ended up being just digital QQQ. That's what it turned out to be, or digital ARC.
There you go.
So
a little more like ARC.
I don't know if necessarily money comes out of Bitcoin and into gold. And keep in mind, you can't have money come out of Bitcoin because for every seller, there's a buyer. So,
True.
And same with gold. For every buyer of gold is somebody selling that gold to that person. So money doesn't come out of an asset class. Money gets just shuffled around.
I'd like to, you know, I'm going to ask that question in reverse to my next Bitcoin guest. As you know, why would you prefer Bitcoin over gold?
Yeah. Now, I Bitcoin and owners and gold, they still have a similar mind. You know, obviously putting aside the people that were just buying Bitcoin just because it was a hot thing for a while and they just wanted to ride the train. But the basis and theory for Bitcoin is still similar to owning gold. So there is a soulmate type relationship for the creation of Bitcoin and those that are critical of central banks and the policies they've conducted and the bullishness those people have on gold. So I sympathize with Bitcoin and you know, maybe it does weather this and stand the test of time. But time is not 13 years. Time is going to have to be something more than that, because the last 12, 13 years, the only thing Bitcoin has really known is QE, zero rates, and that's it. Well, you know, that's a nice childhood, you can call it. Now it's getting tested and life is not as fun, and we'll see how this plays out.
Okay, so let's go from childhood to adolescence and talk about China and what you're seeing there. I know their equities really took it on the chin last year, but there's been some outperformance by Chinese stocks. Are they a no touch for you, or is there Shanghai seems to have the best structure of any bourse out there? You have a view?
Yeah, we have some exposure, sort of kind of indirectly. You know, we own some of the Macau casino stocks. One's Las Vegas Sands, so it's not really a Chinese company, but they do a lot of business there, of course. So AIA Group, which is the largest insurance company, or one of them in Asia, they're based in Hong Kong and they do a lot of business in China. But to me, investing in China is I'm less worried about the regulatory issue. You know, like on the audit side, because you can just buy the shares in H shares in Hong Kong, as they are fungible. but I'm more concerned with just this maniacal approach to COVID, and it just doesn't make any sense to me whatsoever at this point, with the rest of the world proving how you can successfully manage it. I mean, I know China's worried about their healthcare system, but look at India. I mean, India, which we're very bullish on, doesn't have even the healthcare system that China does, and they have powered through this. Now, granted, they have a younger population, which can handle it, but I want China to pivot, and they haven't done it yet.
Yeah, that's leading people to say there are other reasons for it. And in fact, I don't know, is it fake news that they could, Chinese, when they go to their ATMs, they have a limit to what they could take out on a daily basis? Or was that fake news?
I don't know. I mean, with this authoritarian government, anything's possible, of course.
Yeah. Okay. What's on your radar going into here we are, it's the summer, just started. What are the major events?
Yeah, the next big thing is corporate earnings. Okay. When you look at the three drivers of stocks, it's the multiple, it's revenue growth, and the profit margin on that to derive your earnings per share. Well, we've already seen a re-rate on the multiple side. We're about to see a deceleration on the revenue side because we're either in or about to enter a recession. And we've already seen a moderation in profit margins. So this earnings season, which starts in a couple of weeks, even though we got a taste of it with FedEx last week and General Mills and today, that is going to be the next major driver, because earnings estimates from the sell side have not budged, basically. And that, to me, the 228, 230 earnings estimate for this year, to me, is la la land. And I think earnings will go a long way in readjusting. Earnings season will go a long way in readjusting those expectations.
Okay. Any levels you're looking at in S&Ps? I'm sensing you feel it's not priced in. So a lot of people were talking about going back to the pre-COVID highs, about 3,200. Is that viable?
Yeah, it's like around 3,350, 3,400. Yeah, I think that that's definitely possible, and there's a wide range of outcomes here. I mean, even if you just look at the average bear market, it's down 35%. Now that's average. Some are obviously down less, some are down more, but that would take you to 3,100. What if we have a bear market that's similar to the two prior to COVID? Well, that takes you to 2,400. So there are a range of outcomes. So you really have to not be dogmatic, and you just have to be aware of that. It's a bear market. You have multiples falling at the same time earnings are about to fall, and that's what creates a bear market. At the same time, you have inflation at 40-year highs, the most aggressive monetary tightening in 40 years, and that it's going to be a very choppy, challenging investing environment for a while.
Okay. Are you concerned at all about what's happening between Russia and Ukraine, and anything geo that you have your eye on?
Yeah, of course, it's a concern, just because when you are in war, you just don't know where it goes, what mistakes are potentially made. Now, I don't think that Putin is going to focus on a NATO country. I think he wants what he wants in Ukraine, as tragic as that is. But you never know what sort of mistake is made, or an accident that occurs that can create something more. You always have to worry about the U.S.-China relationship, and just seems to be so toxic. And the world needs strong China economically. The world needs their supply chains. The world needs their consumer and their growing middle class. So we want China's economy to succeed. It's just this very, again, authoritarian,
acrimonious.
Approach. Yeah,
and that's the only thing that both
dangerous.
Democrats and Republicans agree on, is their disdain for China.
Yeah,
they both
exactly.
It's weird.
I feel like we have to stop being afraid of competing with them, and that seems to be, our fear of that seems to be driving policy. which
Okay.
I don't think necessarily leads to good decision making.
Okay, Peter.
We've done pretty well competing against the world over many centuries.
Yeah. What are they afraid of? We're always, that's us. We have that competitive spirit, and Peter provides some things that might give you a little competitive edge on your view of the markets here at the book report. And you have both free, and then you could also subscribe. Peter, it's always great talking to you.
Thanks, Dale. I always appreciate having me on.
Yeah, and I cheer for you when you're on CNBC.
Thank you. I appreciate that.
Okay, so everyone, Peter Boockvar, thank you very much, Peter, and I'll get a hold of him. We'll talk in the fall, see how things are shaping up in this Meshuggah world.
Great. Be well.
All right.
Bye.
Peter Boockvar, everybody, and remember, don't just count your pips, count your blessings. Hoping that this session today helped you out. The guys will be available in 20 minutes on the Morning Edge. Have your questions ready. And like Peter says, a lot of real smart guys I know are starting to smell a potential top in the dollar. So get your war chests together. So that's a wrap, everyone. Have a great day. Adios.